You're about to join Jerry Parker, Moritz Siebert, and Niels Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Hey everyone, Niels here. Just jumping in with a slightly different introduction to this part 2, I think we can call it, of the Systematic Investor series with our special guest, Andreas Clenow. As some of you may know who listened to our normal recording, we had a bit of an issue at the end, so we had to cut that off, but we have recovered it by now. And so we're just jumping straight into our conversation that we had with Andreas, where we were discussing some of the topics, I think, surrounding backtesting at the time. And there was a lot of other good stuff coming up later in the conversation. I want to make sure you got that as well. So sorry for the arbitrary introduction this week for part 2, and hopefully you will enjoy it. We'll be back as usual next week, and in the meantime, take care.
It is, but if you pull the argument long enough, you have. Sometimes you see this analysis where somebody is looking at 300-400 year study of price action, and I'm not entirely sure that is very relevant. What happened back with 300-400 years ago, but markets change. I certainly agree. We have to look at all the data, especially different type of environments. I think that's the most important thing, that we have different type of economic climate out there, and we need to see how things perform in different type of economic climate. That's more important, really.
So let me round off my questions on at least my questions. There could be more, of course, but just my questions in terms of backtesting and designing systems in from your point of view. At the end of the day, you can do your backtest and you might end up with a large number of parameter combinations, and so many of them may look good for various reasons in various periods. Have you any advice or rule of thumb for those who are in that stage of their career as to so how do I select from this unit? There could be 100 different or more than 100 different combination of parameters that I can choose from. So how many should I choose for my live model, and how do I choose? So again, to avoid some of the obvious mistakes. And maybe there's a final question to that would be, do you just choose and stick with them, or do you choose and actually have a rule for making those choices on an ongoing basis to kind of recalibrate your model? And I ask that because that's one of the things we do at Dun. We've done that the last 14 years or so, where we allow the model to kind of recalibrate itself on occasion, or on a regular basis, I should say. And also some of the research that we've done, and this was just purely looking at look-back periods. What's the optimal look-back period been by calendar year? It changes dramatically from year to year. You can have a 20-day look back as being the best. The next year, it's 260-day look back that's the best. So just as to keep it simple, how do you think about these things in terms of choosing your parameters and those things?
In my view, unless you're on the machine learning side, then of course all bets are off. But otherwise, if you're running more normal things, you should keep parameters as few as you possibly could. The problem is, I'm sure you know all of this already, if you use too many parameters, you're more or less ending up with some over-optimized model with no predictive value whatsoever. What I like to do is trade simple, broad concepts. In my view, trend following is an excellent candidate for such a thing. You're trading a concept, not the exact rules. If the parameters really matters, if your strategy is very sensitive to the parameter inputs, it's not a robust model, and it probably won't last very long. It probably will not.
But sorry to interrupt you here, Andreas. Sorry to interrupt you here, because that's an important statement you're coming with. But don't you think all models, regardless, is very depending on what parameters you put in? I can think of easily finding parameters for trend following that doesn't work, but I can also think of many that does work. So
Sure.
Yeah.
I mean, you can't put crazy parameters in,
fair
but
enough.
if you toggle around the parameters a little bit, change your parameters randomly, plus minus 20%. If you get dramatically different results, then you probably have an issue. I mean, obviously, if you multiply them by minus 50, you might have an issue. But you see what I mean? You need to have some sort of parameters stability.
Yeah.
So if you're trading a broad concept, because I mean, once you throw in, I don't know, 30, 40 parameters in there, can you really explain what you do anymore? I mean, if somebody asks you, what are you trading? Well, I have this complex math and I have all these indicators with all these numbers and money comes out. Yeah, but what are you trading? What market phenomenon are you exploiting here? I mean, what's the reason for this to be working?
Yeah, and I'm also not thinking necessarily, Andreas, of parameters being different parameters per se, but I'm thinking, it could be very simple if you just keep things very simple in this example. If you take a price breakout, right? So obviously you have different look back periods, for example, or if it's a volatility breakout, you have different look back and you have different sensitivity of volatility.
I see.
That's what I mean.
Okay.
I don't mean 100 different parameters in terms of different parameter types, but different settings of those parameters. Yeah.
So my preference to handle that. Now I get your question. Yeah. My preference to handle that is to break that down to individual models. Instead of saying that if this breakout is true and if that breakout is true but that breakout is not true on different parameters, then do something. Right now you're getting a complex model, or you scale positions up or down. You take a little bit more risk if this happens, if that happens, it's combinations. I don't like that, mostly because it adds complexity. It makes it difficult to get an overview, difficult to evaluate what part of this model is valuable and not. What I would prefer instead is, if you take such a model and you break it apart, you build 10 different simple models. Now, if they trade at the same time together, you get the same result, right? Basically, they will vote up or down position size, right? Each of them adds one risk unit, whatever there is right? It adds or removes, right? Maybe they take opposite positions and now you're flat, right? But you get the same result. Now you have individual component models which you can have a better overview of how they're performing. You can evaluate them, see if they make sense. That to me is a better way to handle parameters than just throwing more parameters into the same model.
I agree with that completely. Yeah, cool. Jerry, Moritz, what are your where do you want to go now?
I was going to answer Moritz's question. Like, the way I look at that is that the markets have changed. Trend following traders are impacting the systems and the parameters, and so we need to change. For instance, in the late 90s, shorter term systems didn't work very well. They stopped working, let's say, and that's my opinion. So we all have to have this longer look back period, and then what Andreas was sort of saying is, the world changes. So we have both these changes happening all the time. So there's too many trend followers, there's too many fast computers, backtest programs, people trading trend, and so the markets are choppier. We get these trends, and then they crash, or they go lower, then they go back to the highs. So the shorter term stuff needs to be adjusted. And then we have things that happen, zero interest rates, and this is changing as well. And so I think that these are the two dilemmas. Which change are you talking about? And one of the things, when we went longer term, we noticed that longer term had always been better. So when we traded shorter term, it wasn't better than the extra long term that we're doing now or back then. And so that's good. So we didn't just have to use the most recent data that would give us evidence that the shorter term stuff didn't work very well any longer. So we were able to incorporate all the data and say, oh, great, going back 30 years, the longer term systems work well. And then just another idea that I would have would be that I don't like to look at the historical backtest in terms of the hypothetical returns and the NAV, the kind of, this is how my system has done every year, every day over the past 30 years. I discount that totally. So I like to just look at the average win, average loss, average trade, win percentage, just what I call the trade stats, and sort of say, okay, I've got a healthy system, multiple different parameters here, different look back periods. Let's say they're all over a 20-year period, all these systems make about the same amount of money. They can have, as you said, they can have way different performance on an annual basis, even if they're medium to long term. And so then let's just ignore, the worst drawdown, and it's probably going to be worse than the worst. So I don't know if you have any comments on that, Andreas.
No, I mean it makes sense to me. Obviously, you have a different, longer and wider experience at that point, but no, trend following in the long run, in my view, has, as you said, it performs better in my view. If you're looking at the actual results, I see larger drawdowns often for the long-term trend followers, but personally, I don't have a particular issue with that. If I trust the manager, if I trust the long-term track record, I know what they're doing. My view, I prefer to see that than they're going to too much diversification in terms of other type of models that you get something pure. The world is changing, but what do we do about it? We certainly have much more trend followers coming in, changing the behavior of trends, in my view. I'm not sure if you have seen, I've published some pretty simple models that try to take advantage of this phenomenon of more trend followers coming in, basically trying to reverse the model I did in my first book by having an entry point where my core model from the first book will stop out, and you instead buy at that point. You wait until that happens and buy instead for a shorter term trend, shorter term trade, which seemed to work just fine. And this particular type of model has worked much better since the CTA space have massively exploded in size. So I think trend followers themselves are getting a footprint, obviously.
And how do you define the CTA space exploding? Because I failed to see that, and actually I saw that. I think it was Abbey Capital that did their analysis recently about the size of the CTA space, and they were basically, when they volatility adjusted, they were basically getting to pretty much the same number in terms of real trend following AUM on a volatility adjusted basis as we saw in 2009. Now, I understand that there might be more end investors applying trend following techniques. So if that's what you're saying, I'll agree with that. But I don't see our space exploding. I don't think we've become that popular.
No, but you're saying you're saying since 2009, and I mean that's around when the growth really happened, right? The attention from the 2008 year and all of these things, right? So the main growth happened there. I see. If you look into the big changes in the space for the past, say, 5 to 10 years, in my view, is less the AUM, the net industry AUM, but rather asset under management for those not in the business out there listening. The issue is more of the concentration, that it used to be a much more diverse field with a lot more medium-sized players, and now we're seeing a concentration of assets in the larger players. Good for you guys, but it's bad for us poor medium 9-figure guys. We're the tiny ones. But we're seeing, of course, the brand names coming in, and that's why for medium term, especially even more for smaller asset management shops doing trend following, it's becoming less interesting as a business because of this concentration of assets into the larger players. But that's the bigger change I see at the moment.
Yeah, sure. No, absolutely.
So would you still go out and start a systematic trend following business these days? Or would you outright say, no, that's a very terrible business idea? Or if you said, yes, I want to do it, how would you go about it and how would you emphasize raising AUM? I mean,
as far as trend following is concerned, it's a little bit late to the party to go and start it. I mean, you might very well succeed, but you're not exactly an entrepreneur now. It's a bit like starting a mutual fund business. It's that's a bit harsh, perhaps, but what I mean is, no pun intended, but the CTA space has been commoditized, right? It used to be a niche strategy. It used to be something kind of new and exciting, and it's not really anymore. You're going up against the giants. But fine, if you can get the assets for it, I mean, that's how the money is made in this business on asset under management. If you can raise the assets for it, then fine. How do you raise the assets, the initial assets? Well, that's always the difficult question. Not everybody can slip on a banana peel and land on $50 million, but if you can, that's great. I'd say first, raise your profile, become visible, get noticed by people who probably have a little bit more money than you do. Those are the people you need on board. Be prepared to give up a large chunk of your income, of your business early on for seed money. Nobody's going to give you, if you're new in the business, you want to start something, nobody's going to give you a large chunk of money without taking a big chunk of your return stream and as an exchange for that. The other thing to be very careful with these days is, at least on my side of the pond, is regulations, which has become much more onerous in the past decade. It is much more expensive and difficult to properly comply with European asset management, especially fund management regulation. So take that seriously. Don't go just start something and get 30 people around your neighborhood to invest because you might be in violation of some law and now you've burnt yourself in the industry. As I understand it, I don't know much about it, but as I understand it, it's actually much easier to start in the US. I think it's still a little bit easier on the regulatory side there, but in Europe, if you want to run pooled money, that's expensive. Look into that, do it properly, or move to jurisdiction where you can do that.
I wanted to follow up on the question. I think there's a great point also that Moritz raised about this whole thing, if you were starting again and how would you do it and all of that stuff. But I wanted to also ask you a little bit about how you think CTAs and trend followers in general, how should we position ourselves? And I ask that in the context of this term being introduced about 8 or 9 years ago called Crisis Alpha, which people clearly related back to 2000 and the IT bubble and then the financial crisis where CTAs, trend followers in particular, did really well. So now we were a Crisis Alpha strategy. Of course, we know we can make money when there is no crisis, like 2019, etc., etc. But I think it creates some tension and potentially misunderstandings about what we really are. And I saw that David Harding has come out recently in their year-end review saying that they certainly don't want to be in that bucket. And I agree. I mean, I think we should be viewed as an uncorrelated strategy, but Crisis Alpha has really, and I love the people who kind of invented it, so it's difficult for me to be too harsh on the term, but I just don't think it's helpful for investors because I think they gravitate towards us being a hedge for whatever bad comes in the equity markets, and I don't necessarily think that's a good thing to rely on. So where do you sit on that, and how do you think we as an industry should position ourselves in order to attract attention from investors who may not be as deep into it as you are, but just in general people who really need it in their portfolios?
No, I mean, I completely agree that who knows what's going to happen the next time stocks crash. I mean, sooner or later they will crash. I'm not the guy who says they're going to crash tomorrow, but I mean, I would be absolutely shocked if we don't see a massive crash in my lifetime. If that's going to happen, next year or in 10 years, I don't know. I'm not making such predictions, but sooner or later, what is trend following going to do then? Who knows? I mean, probably it will not crash, but is it going to have a massive year just because equities tanked? I wouldn't bet on it. Maybe, maybe not. I think trend following is a great complement to traditional investments. It belongs as a building block in any portfolio, in my view. If you have a traditional portfolio, you complement it with trend following allocation. I think that it has a great added diversification value. But you shouldn't rely on that next crash is going to explode in value. How should you position it? I think what I appreciate when I talk to, I talk to a lot of not just trend following shops, but a lot of hedge fund shops, since we're on the allocator side as well. I very much appreciate transparency in terms of what is the strategy. I mean, how do you trade? What can we expect from it? And from that point of view, it ties back to a bit what I mentioned earlier about combining strategies. When I allocate to a trend follower, I very much appreciate if they really are a pure trend follower, because I know exactly what I'm going to get. If somebody tells me that this is how we do, here's a bunch of trade charts from last year, here's how we entered positions and exit positions, let me show you a bit about our risk models and how that works. It's great. If somebody tells me we're a secret black box model and we have 20 years of great performance, take it or leave it, we're not going to tell you a thing, that doesn't really do it for me. I think CTAs being, and I don't mean this in a negative way, but CTAs being a fairly simple strategy. Conceptually, it's a pretty simple type of strategy. I know it gets complicated once you get into the nitty-gritty details, but conceptually it is easy, which means it's explainable. I think that's the opportunity or the advantage trend followers have over many other type of hedge funds. You can actually sit down and explain your strategy to pretty much any investor regardless of knowledge of the industry. You try that with some, merger arbitrage strategy, and that's not going to be easy to explain. I think CTAs should trade on being the open, transparent, and explainable model. Don't try to be the secret black box thing. That was a cool thing 20 years ago, to be the secret black box thing that just produces money out of nothing. They rev it out of the hat, but nobody wants it anymore. They want to know how the sausage is made.
Moritz, Jerry, what else would you like to talk to Andreas about, as long as we have him for a few more minutes, I'm sure?
I've exhausted my questions, but I look forward to another time together. Not so long, not another 2 years, but this has been fantastic.
Same here.
To add on that, last time I met Jerry, we met at the CMT conference 2 years ago in New York.
That's right.
And in case any of you guys or anybody else listening, I'm going to be there again this year in April at the CMT symposium. So I'll come and speak then again, and this time about applying term structure analysis or incorporating term structure analysis in the field of technical analysis. My point will be to try to expand the subject of technical analysis to include analyzing the term structure. That is the difference in price between different deliveries of the same futures market.
Sounds great. I've exhausted all my
Sounds
questions too. It's been great to speak with you, Andreas. Hope to see you again soon, and thanks for joining us.
Sure. I haven't quite exhausted all my questions, Andreas. Sorry to say that, but there we are. No, I wanted to, we're going to respect your time. It's Sunday, and you need to get back to your family and so on and so forth. I want to give you the opportunity, if you want, to talk a little bit about your latest book.
Thank you.
And then I also wanted to end up with a kind of a left field kind of question, which goes into the bucket, which we've tried before, Andreas. I call it general and fun, and I think it could be a good one just to hear your view on this. And that is, if you were having 4 people for dinner, people that you would really like to spend some time with and have some interesting discussions, and they could be living, they could also be people who are no longer with us. Which 4 people would you invite for that dinner?
How about 3 of you, and why don't you bring, David Harding as well, and we'll have a good time.
I think politically that is the right answer, so you get full credit for that one. Your latest book, Andreas, anything you want to share with our audience on that?
Sure, the obligatory plug. We mentioned before my first book. I did 3 books all in all so far. I have a manuscript laying around for a 4th, but who knows how long time that's going to take. So my 3rd one is quite different. Trading Evolved is the book, and I usually get asked by, you're pitching to a publisher, for instance, trying to get a book deal, which you may or may not want. It's a whole longer story, but the publisher will always ask you, what's your target group for the book? And I always have the same answer. My target audience for my books is always myself a certain number of years earlier. I write for myself. I write something that I wish I had read X number of years earlier. That would have saved me a lot of time and pain and effort earlier. And the latest book is a very much more practical book than the previous ones. It's my attempt of tricking people to learn programming without knowing that they learned that. I guess I gave away the secret here. Basically, it is a book describing in detail not only the same strategies or variations of them from our previous books, it has a whole bunch of new ones for futures and stocks, but I am building it up bit by bit with actual programming code, teaching you how to implement all of this in Python. My point being that, and I really believe that Python has, the development of Python in the last few years, much thanks to the great people who made some free libraries for the past few years there, McKinney among others. It has become a vital piece of quant finance. You can get stuff done that it would take me weeks to build in C# or something like that, and now you can get it done in Python in a matter of minutes. So I'm showing step by step, how do you get into this, how do you build a backtester, how do you get the backtester up and running, hook it up to your data, build complex futures and stock models. And my desire here, what I want to accomplish here is I want to get people to get into proper and robust backtesting on their own and move away from some of the more limited retail kind of things that a lot of people work on, because now we have for free available all these brilliant industry level tools that anybody can use. So that's my plug basically.
Yeah, no, I mean that's perfectly fine. Now, I said that I had more questions. Now that I've asked all of the questions, I also want to raise one more question, which comes from a listener, and this is from Brian, who was curious about your thoughts on whether or not trend strategies have been distorted by strategies such as by option market effects. So it doesn't give you much detail in the question, but do option markets and the effects of option markets, do you think that distorts trends or trend following strategies?
Not that I'm aware, but if I missed something, then Brian, please send me an email and explain, and maybe I can learn something.
Sure, that's fine. Before we wrap up, let me just quickly run through the performance so far. I mean, obviously we're still in January, so the month-to-date performance is the same as year-to-date, as some people have worked out. So the general trend of the CTA indices is that they're up for January so far. 89 bips for the B-Top 50 index. I think actually exactly the same for the SocGen CTA index. The trend index up 1.14% for the month and the year. Short-term traders index down about 31 basis points, and the bridge alternatives up 75 basis points. I think that is it for this week. Andreas, thank you so much for spending part of your Sunday with us. We really appreciate this, and I'm sure all our listeners do as well. So it's been a real treat. And any final words, any final thoughts you want to share, Andreas? Or
that sounds ominous. No, nothing I can think of at the moment. But it's been great being here, and I'm not sure how many years it was since last time, but hopefully I get to come back again and without having to write another book first.
Absolutely, you are welcome at any time. So from Andreas, Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.